Powell's pivot sparks debate over rate cut size and future easing path. Bloomberg, with Federal Reserve Chair Jerome Powell signaling that interest rate cuts are on the horizon for next month, bond traders are now honing in on the specifics of the initial reduction and the broader trajectory of future cuts. In his keynote address at the Fed's annual symposium in Wyoming on Friday, Powell indicated that the time is ripe for reducing benchmark rates, which have been at a 20-year high. This was the clearest indication yet that the long-anticipated rate cuts are imminent. Though Powell did not specify the magnitude of the cuts or the future course of monetary easing, he highlighted progress on inflation and emphasized that the health of the labor market will be a key factor in guiding policy decisions. His remarks led to a decline in U.S. Treasury yields and the dollar, while stocks saw a boost as investors interpreted the speech as a signal to embrace higher-risk investments. Markets will need to absorb this speech and remember that both they and the Fed remain data-dependent, said Jack McIntyre, portfolio manager at Brandywine Global Investment Management. Despite Powell's dovish tone, McIntyre noted that the data must now support this shift. This situation was further complicated by recent geopolitical tensions in the Middle East, where Israel's strikes on Hezbollah targets in southern Lebanon have heightened uncertainty. This new development could influence traders' strategies when markets open in Asia on Monday, particularly in terms of the demand for safe haven assets like treasuries and the dollar. As of Friday, market bets on rate cuts were beginning to take shape. Traders increased their wagers on a half-point cut in September. Additionally, the weakening dollar was becoming a preferred choice for new carry trades, which involved making risky investments with borrowed funds. Following Powell's speech, Treasury yields across the board fell, with the 10-year yield dropping to 3.8%, down 8 basis points for the week. This decline contributed to positive returns for U.S. government debt, which had already gained 1.44% through Thursday, according to a Bloomberg index. Treasuries are on track to achieve their fourth consecutive month of gains, marking the longest period of positive returns in 3 years. Meanwhile, the anticipation of lower Fed policy rates has driven the S&P 500 index up by 18% so far in 2024, and the Bloomberg Dollar Index has decreased by over 4% since late June.